Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Juice. Big banks reported earnings last week, and despite solid results, an unfortunate surprise lurked underneath. They couldn't escape the long reach of inflation. Citigroup and JP Morgan saw shares trade lower, even as earnings and revenues beat estimates. But how can that be, you ask? Well, cost controls failed in Q4 as non-interest expenses, i.e., those tied to operations, rose. Citigroup saw operating expenses jump 18% year over year in Q4 to $13.5 billion. A big chunk of this was tied to exit costs from its Asia business. Excluding that piece, they still jumped 8%. JP Morgan's non-interest expenses jumped 11.5% year over year in Q4 to $17.89 billion. And the bank said they expect expenses to climb 8% to $77 billion in 2022. However, Wells Fargo managed to drop non-interest expenses by 10.8% to $13.198 billion. Analysts questioned the difference between the banks. Management pointed to higher labor and wage costs to attract and retain top talent. Wells stood as the outlier after having several rough years plagued by scandal. And as expected, loans continue to grow at JP Morgan by 6% and Wells Fargo by 2.5%, mainly in the second half. However, this was driven primarily by securities and corporate lending. In fact, Wells saw a decline in consumer and commercial banking loans year over year in Q4. Interestingly, Citigroup saw no loan growth. All banks said they expect higher interest rates to improve their bottom lines by widening the spread between the interest they pay on deposits and the interest generated on loans. However, one of the reasons JP Morgan saw shares fall was the decline in trading revenue. Analysts expected a 13.5% slide in fixed income trading, when the actual number came in closer to 16%. The bottom line is this. The sell-off in banking stocks seems a bit absurd. All three of these companies are still incredibly cheap and expect to increase profits in the coming months. Of the tickers, we like Citigroup the best in terms of value. However, if you're looking to play the sector more broadly, consider the XLF Financials ETF or the Regional Banking KRE ETF. That's all we have time for today on The Juice. Click follow and subscribe to The Juice email for your daily dose of market minerals.